Welcome to the Morningstar series, How to Be a Better Investor. I'm Holly Black. With me is Dan Kemp. He's from Morningstar Investment Management. Hello.
Hello, Holly.
So we've been talking about all the common mistakes that we all make when investing and how we can maybe try and avoid those to become better investors.
That's right, and there are lots of these mistakes, and people aren't going to manage to overcome them all at once. It's important to do one at a time.
So which downfall are we talking about today?
Well, I thought it'd be interesting to think about recency bias, which is also linked with something called availability bias. So we'll cover both of those. And recency bias is that idea that what's just happened to you is likely to carry on happening in the future, or the environment that you're in is likely to carry on into the future. Now, we know that as we look back through history, that almost never happens, that environments change frequently and significantly, but nevertheless, when we're looking at a particular environment, when we're living through an environment, we normally assume that it will carry on.
And this is basically because we've got short memories, so we just latch on to the nearest one.
That's right, and we attach ourselves to a herd, to some sort of movement forward, and that can lead to problems.
So how does this affect my investments?
Well, it can affect it in a number of ways. The most obvious is the way that you think about returns. So if we were sat here at the beginning of last year, we'd have been talking about the fact that almost no market delivered positive returns in 2018, and everyone was feeling a bit down. As we sit here today, most markets delivered very high returns in 2019, and everyone's feeling a bit more chipper because people are expecting that to carry on and struggle to remember a time when they were getting negative returns. And so what that does is it tends to encourage us to take risk at the wrong times. We tend to take risk just after there's been a very sharp rise in asset prices, and we tend to become very risk averse when we've seen a fall in asset prices. And so this is like people deciding they're not going to go to the shops in the January sales because the prices have fallen. They'd much rather go when the prices have just risen by 20%. It's a peculiar phenomenon which occurs frequently in investment. And so that's the first thing that people need to be aware of. Just remember that the future may look very, very different from the past. That just because we've had very strong returns or very weak returns doesn't mean they're going to continue for any more time they have.
And if everyone's thinking the same, I guess that's when we end up buying high or at the top of the market and selling at the wrong time at the bottom. Exactly
right. That's where we avoid the sales and go and overpay for things. So it's a real problem because when asset prices are high, it's not only that the future returns are lower, but the risk is actually greater. You've got further to fall. And so it can hurt people in two ways.
So what's availability bias?
So availability bias is linked with recency bias, and it's the idea that some memories are more available to us than others. And so when we're trying to think about scenarios, when we're trying to think about the future, we tend to latch on to the things that are most available to us. And the thing that people think about when they think about investment often is the big crashes.
That's why everyone still talks about Black Friday whenever we get to October.
Exactly right. So people still focus on crashes in October from 1987. Or if they think about a recession, people typically don't think about a mild recession anymore. They think about the global financial crisis in 2008. And so that's much more available to them. It's much more vivid. And so people have to remember that when you're thinking about scenarios, try and be aware that the more vivid ones may not be the most likely. In fact, they may be less likely than the ones that aren't vivid, but nevertheless, you tend to plan your scenarios around the vivid ones.
But you can also, maybe if you look at discrete returns, so you can see individual calendar years, you probably see that it's not always that bad.
Yeah, absolutely right. Or even look at scenarios that aren't as vivid, so mild recessions or slow periods of growth. These things that we tend not to focus on, but nevertheless may be much more likely.
Thank you so much for your time.
Thank you. It's been great to be with you.
And thanks for joining us.